Hi, I'm Jim Smith.
And I'm Martin Fox. Welcome to our first investment update for 2025. I think it's fair to say that we live in uncertain and interesting times. Jim, please take us through the headlines.
Thank you, Martin. For the 3 months ending 31 March 2025, we saw markets initially move ahead, but then lose momentum and decline amid growing concerns about the specifics for Donald Trump's proposed tariff plans. The detail of the plans were announced on the 2nd of April, dubbed Liberation Day, when the US announced the most sweeping tariffs seen since the 1930s. This initially sparked a market-wide sell-off in share prices as investors grappled with the implications for global trade, company profits and economic growth. Here in New Zealand, interest rates were cut to 3.5% following a 0.5% reduction in February and a 0.25% reduction in April. When 2025 started, economics were predicting an improving economic outlook for New Zealand after 2 years of near zero growth, although these predictions will need to be reassessed in light of the recent tariff announcements and implications for global trade.
The US tariffs that were announced as part of Liberation Day were much higher and widespread than had been expected, and consequently markets fell steeply. Economists are still scratching their heads about the methodology used to set the tariffs, but it is very likely that we will see an increase in the price of goods sold in the US, leading to lower demand and reducing company profits. The secondary impacts of the tariffs depend on what other countries do and are therefore much harder to predict. Will other countries follow China's lead and impose reciprocal tariffs on the US? Generally, the higher the tariffs go, the more this will suppress economic activity, reducing demand for products and services, and again leading to lower company profits. There is also longer-term impacts such as a reworking of global supply chains. Will companies take a wait-and-see approach and try and ride things out, or will they look to reinvest elsewhere? These developments and the potential for a prolonged trade dispute introduce significant uncertainty into the markets. Historically, such uncertainties can lead to increased volatilities and impact corporate earnings, particularly companies that are heavily reliant on international trade.
Stepping back now and looking at investment returns for the year ending 31 March 2025, the S&P 500 index was up 13.9% for the year, although these figures don't take into account the fall since early April. The MSCI World ex-US Index, which is a broader measure of stock market performance of developed markets outside the US, was also up 11.6%. New Zealand bonds were up 7.3% and the Australian and New Zealand share markets returned 3.8% and 2.1% respectively. It remained a similar picture for the 3 years to 31 March 2025, with the S&P 500 index rising 16.6% per annum, whereas New Zealand bonds and New Zealand shares returned 4.2% and 1.3% per annum respectively. The 10-year numbers to 31 March 2025 continue to look impressive, with the S&P 500 index rising 15.6% per annum. New Zealand shares returned 8.7% per annum over this period, whereas Australian shares and New Zealand bonds were up 7.8% and 3.4% per annum respectively. These longer-term numbers include the steep market falls after COVID and have rewarded investors that remain disciplined despite the significant downturn. If we now look at the New Zealand dollar compared to some key foreign currencies, against the US, we can see the New Zealand dollar has been relatively weak since 2022 and is currently trading well below its 10-year average. Against the British pound, after gaining ground in 2016 after Brexit, the New Zealand dollar has been steadily losing value and is sitting close to its 10-year low. Compared to the Australian dollar, the New Zealand dollar looks weak again, although perhaps not quite as low as compared to the US dollar and British pound.
With the recent market turmoil and the global situation remaining fluid, what should investors do during this time?
Well, firstly, it's important to remain calm and avoid making any hasty decisions based upon short-term market movements.
While the current environment is challenging, it's important to remember that markets have historically recovered from such periods of volatility. History consistently shows that staying disciplined through uncertainty leads to better outcomes than reacting emotionally to short-term market moves. Going to cash might ease short-term anxiety, but it locks in losses and risks missing the rebound.
Within your portfolios, you would have an allocation to defensive assets, being cash and bonds. These defensive assets continue to perform well and help provide a buffer to the falls in share markets.
The international situation remains fluid, with potential for further policy changes and market reactions. We will continue to monitor developments and your portfolios, but maintaining a disciplined investment approach is key.
And please remember that successful investing is not about chasing returns or reacting to short-term market events, but trusting the process, as markets tend to reward patient, disciplined investors.
With the media headlines and market movements, this is naturally an unsettling time for investors. If you have any concerns, would like to review your plan, or simply want to talk things through, we are always here to help. So please reach out to Jim or I if you have any questions or we can assist in any way.